So until now, we talked about historical risk premium. Remember, just like the true value of a firm is not observable, the true market risk premium is not observable in our eyes. We have to estimate it. Okay, don't give up. Estimation is a statistical way of getting to some other unobservable true number called parameter, okay, in statistical jargon. Okay, then how? Two approaches: historical premium, done, and then implied premium is an alternative way of doing it. Okay, so implied premium, what is that? Well, if we assume that stocks are correctly priced, the assumption is important here. If we assume that the stocks are correctly priced, okay, in the aggregate, and we can estimate the expected cash flows from buying stocks. We can estimate the expected rate of return on stocks by computing an internal rate of return, IRR. You remember that? What is that? The discount rate that makes your NPV equal to 0. Okay, right. Subtracting out the risk-free rate should yield an implied equity risk premium. Okay, so this is a back-solving approach. We need a lot of assumptions and information, okay, to compute, to estimate this implied equity premium. Okay, this implied equity premium is a forward-looking measure, and it can be updated as often as you want. Okay, any minute, every day, you are so inclined. If you are so inclined. Now, implied premium. Give me some example. Okay, as of August 2011, simple version first. Okay, I'm not going to ask you complicated version, I guess, right? Simple version. S&P index is at 1418 today. Okay, they're a long time ago. You can see 10-year treasury rate is 1.81%, AAA credit rating, and then the PE ratio of average PE ratio of the United States companies. Okay, so I should say representative or average, okay, PE ratio of US companies is 16.31 times. Okay, that means for any dollar of EPS, the investors are willing to pay 16.31 cents for average stocks in the United States. Okay. Dividend payout ratio of average, right? Dividend payout ratio of United States companies, 60%. That means for a dollar of net income they had, right? 60% is paid out. 60 cents are paid out as dividend. 40 cents are reinvested into their business. Okay, and this dividend we include repurchases, because this is repurchase or dividend. They are the same payout policy. Okay, 분파이 policy in Korean terminology, right? How they can share among the shareholders, equity holders, right? And party based on that. Expected earnings growth rate, okay, net income growth rate, 1.87%. Let's assume you have all these information, right? Then what is the implied equity risk premium? Okay, well, we can set up the math like this. S&P 500 index is nothing but the whole market cap, market value of equity of the stocks, 500 different stocks in our sample, right? And then those market value of equities for these whole stocks is nothing but the discounted future cash flow of these stocks, right? So that will be the dividend, future dividend, discounted at its cost of equity, reflecting its growth rate in their net income. Okay, here actually the growth rate of dividend, I should say it, but I'm assuming the dividend growth rate is equal to the net income growth rate. here, how does it get? Well, dividend itself, right, should be earnings per share times payout ratio. Okay, dividend per share, I should have said. Dividend per share is nothing but EPS times payout ratio. And this thing divided by R minus G that you see over here, the same thing. And then the interesting thing is EPS next year, right, should be this year EPS times EPS growth rate or net income growth rate. Okay, we are not assuming any stock splits or stock dividend kind of things. Don't worry about that complicated issues. Just back to basics. Nothing difficult, right? So this is EPS 1 times payout ratio is still there. Now we have enough information to throw it in over here. Okay, S&P 500 index, of course. Okay, that should be nothing but the EPS of 0. EPS of 0, how does it work? Well, EPS of 0 should be the price times 1 over PE ratio. Okay, because P times 1 over PE ratio, okay, is a complicated fraction. How do you say big fraction? Or 번분수 in Korean terminology. Cancels each other out. This guy go into the numerator, E. Right? So that's why we are doing this math over here. Right? And then the remaining part, you have 1 plus growth rate and payout ratio 60%. And then the denominator RM minus growth rate of EPS over here. Then we have an equation, one unknown. You can solve for this unknown, okay? And the answer becomes 5.62 percentage point. Now what you have to do, get to the implied equity premium. Don't forget to subtract your risk-free rate, okay? So 1.81% risk-free rate. Then it tells me the implied equity premium as of 2011 is 3.808 percentage point. Okay, so it's very interesting interesting idea, and then the mathematical setup, okay, is good for me to test you in your final exam or midterm exam. Okay, so my favorite subject. I'm going to ask you. I told you about it. Yes. Now, implied equity premium Korea, okay? So let's do it, okay? Risk-free rate of Korea, 10-year treasury note, treasury 2.15%, and average PE ratio 17 times, and then dividend payout ratio, including repurchases, 30%, and expected earnings growth rate, 8.4%, right? Was the implied equity premium, okay, what was the implied equity premium? Using this information, right? So, So, you set up the math again, okay? Your Kospi index level, okay, is nothing but your expected future cash flow, which is future dividend, divided by R minus G. And then, if you look at the numerator, it should be earnings per share times payout ratio. This earnings per share should be next year's, right? By the way, this Kospi index or the previous S&P 500 index, I told you this is market cap idea, right? But I should have said this is market cap per share, okay? Representative share price, okay? Market. That's why we can set up the math like this, per share basis calculation, right? Make sense? Yes. So that's how it goes, and then this EPS 1 has to be today's or the historic EPS just before EPS 0 times 1 plus growth rate, payout ratio, multiply everything, and the math looks like this. Interesting thing is you don't have Kospi index level information. You're in trouble, you may say. Mom, I'm screwed. No, you're not screwed, okay? Because you have common things to cancel each other out. Okay? You don't need to know the index level in the first place, as long as you have the mathematical setup correctly and necessary information with you. Okay? So 1, 1, and then 1 over 17, all these things. And if you do the math, you'll figure out RM has to be 10.31%. And then don't stop there. Don't stop there. So many students stop here and get some points off. Of course, there are so many ways of screwing up yourself, and this is one of the ways of doing that. Okay? Don't forget to subtract your risk-free rate, which is this guy, 2.15%. Right? So what's the answer? 1.8%. Is that right? Yeah, this should be the answer. Okay. So expect this kind of problems in your exam. Okay. All right. Implied premium you can obtain as long as you have this kind of information in the big data, right? Big data. For example, the average PE ratio of your whole stocks in the index, and then payout ratio, okay, average payout ratio of those stocks, and then expected earnings growth rate for the stocks in the index, all these kind of things, then you can estimate this implied equity premium at any point in your time. And here what you see is a plot of implied equity premium based on the data available at each given point of time. Okay, for example, standing at 1961, okay, taking the average payout ratio and then average earnings growth rate and all this average figure as of 1961, right? The Damodaran computed implied premium, equity premium on that year, in that year, okay? And then based on the data available in this time point, 1986, he computed once again and again and again and again repeatedly, okay, based on those information available up to that moment, right, up to that year, okay. Now you see an interesting pattern as you look at this time series plot of implied premium, okay. What do you see? What do you see? The pattern of ups and downs, right? Ups and downs. Let me go down here. Hello. Right. The thing is, when is it up and when is it down, right? If you look at the point of up, okay, points of up, that is the point when there is economic shock. And when is it down? That is the point where the market is in the bubble, dot-com bubble kind of things. Again, when is it up? Well, typically when the market is in deep trouble, okay, right? And where was it 1 year ago? 18, right? Up, okay? What's the idea over there? What did I tell you? The intuition of risk premium. The idea of risk premium is risk aversion of the average investors in the market. Okay? High risk aversion, high risk premium. Low risk aversion, low risk premium. Okay? Which means when the people in the market are scared so much, they will be much more averse to take any risk. For example, nowadays, okay, with the Corona-19 virus, who wants to create your own venture and then go to the entrepreneurship? Any courageous person? Likewise, right? You see that point, right? This is high risk aversion period, recession and crash. And then risk premium has to be very, 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 very high, right? In contrast, in bubble time, what happens? In bubble time, dot-com bubble, for example, very low risk aversion. Everybody wants to jump into venture and then do their entrepreneurship. Okay? So much so that, whatever venture was created in 1999 in the name of .com companies. Amazon started over there. And not just Amazon, but thousands of different startups were there following Amazon's model, right? Google. Do you remember Lycos or any other companies in Yahoo? Do you even remember that? It's still there. Yahoo, Lycos. Some of them were taken over. Some of them were just bankrupt later on. But this is a time point. In the bubble period, everybody wants to jump into the stock market and make some money. And this is the point where the stock price is very, very high. So there is an inverse relation going on between the market index level and then implied risk premium. Okay, the next slide shows that. Implied equity premium is plotted with green triangle dots, okay, over the years, and then the S&P 500 index level is shown with red boxes, okay, red boxes. And then what you see is that whenever there is market bubble, S&P 500 index is too high, whereas the implied premium is too low. Okay, soon it gets corrected. Okay, which means stock price crash, and the recession happens. Implied premium shoots up. Okay, and not many people want to do business in that point. That's what we are experiencing right now. Care about implied premiums, right? Why does it matter, right? Well, here's one question. Okay, what if every analyst in the market is using historical premium, but implied premium is drastically different from their their historical premium. Okay. The thing is, implied premium is really reflecting what the market participants are perceiving right now. Okay. Implied premium should be up to date and it should be forward looking, as you saw before. It should reflect the risk aversion of the investors today, right now. But historical premium does not. Okay, what if the historical premium is drastically wrong into a certain direction, and all the analysts are using that wrong premium? Okay, the valuation result will be biased. Okay, wrong result will be there. So in many investment banks, it is common practice to use historical premiums, right? Why? Because they are busy and just want to forget about this math and then just to throw out a number and then say something about it. Haste makes waste, by the way. Now, right, if all analysts in the department use the arithmetic average premium for 1928 to 2016 of 7.96% to value stocks in January 2017, given the implied premium of 5.69%. What are they likely to find? Okay, what's the idea over here, right? The true, or the one that is closer to true equity premium should be this one, 5.7 percentage point. But the analysts are using higher equity premium. So consequently, their discount rate, cost of equity, will be higher than what it should be. What's the consequence on the value? That will be lower than the true value, right? So the values they obtain will be too low, which means most stocks will look overvalued. So much so that, what will they say? Not a good time to buy, okay, no buy recommendation, or weak buy, or sometimes a strong sell, okay? They will be, too much underestimating the true value of the company. So that is a systematic problem when you're using historical premium, right? The next one, okay, which equity premium should I use, all right? Okay, if you assume the premiums revert back to historical norms and your time period yields these norms, then historical risk premium is okay. If you assume that market is correct in the aggregate or that your valuation should be market neutral, then current implied equity premium should be okay, right? And then market makes mistakes and even in the aggregate, but it is corrected over time, then average implied risk equity premium over time should be okay to use, right? So most, how do you say, most scientific equity premium that you can work with is implied equity premium, but there's a limitation. You need a lot of assumptions there, okay? And then you need a lot of information there. Nothing is perfect in this world, in the finance world. Everything has its own limitation. And depending on your assumptions, you have to be consistent with your choice of variables. So that is the message over here. Now, valuation of emerging market firms. So far, we talked about the equity risk premium, especially for the mature market. The discount rates were estimated for the firms in developed markets. Firms in emerging markets are inevitably more risky. In what sense, right? More geopolitical risk, okay? In not only geopolitical, but political uncertainty is also very big. Domestic political uncertainty. For example, if you're valuing North Korean company, okay, I don't know what kind of North Korean company is there, but if you should be investing in, right? What kind of domestic political uncertainty there? Kim Jong-un risk will be there. At any random time, he may come and say, "Oh, screw you! I'm gonna shut down your business," and then you're screwed, man. That's political risk, right? And in China, of course, you don't want to screw up. You don't want to piss off Xi Jinping over there. You don't even say that name, man. Come on. So there is a political risk, okay? And internationally, there is geopolitical risk, right? What if North Korea shoots South Korea, okay? People are sometimes afraid. Nowadays, it's just daily business, day to day. But if you're working in, I don't know, Iraq, right? What if there's some terrorist attack going on, right? From other countries. And if you are in valuing Turkish companies, what if any Syrian terrorist attack happens over there? A regional conflict, all this kind of uncertainty is there. A lot more uncertain, okay? Now, short track record of financial market is also a problem, okay? I told you London has like 300 years of stock market history, right? But some countries have 30 years or less of a history, right, in stock market. So less of a data is available, okay? That would be a problem. More uncertainty in many different ways. How can we incorporate this risk coming from the fact that the company has exposure to emerging markets? So this idea over here is, number one, when your company is headquartered in this emerging market, okay? You're, let's say, I don't know, what company? Formosa in Taiwan, okay? Formosa, what is that? Well, that is a best petrochemical company in Asia, or at least in Southeast Asia. And then that's, Taiwanese company, right? Originated from Taiwan, headquartered over there. What's the risk, emerging market risk over there? Well, the tension between Taiwan and China. What if, okay, unwanted things happen? Military conflict, boom, right? That's the thing you have to worry about, right? Number two is that you're not necessarily Formosa, but a US company, okay? But you have significant exposure. Maybe 90% of your sales come from Taiwan. Man, you are also almost equally exposed to that Taiwan versus China conflict, right? So that kind of, what kind of companies can be? Well, if your company happens to be petrochemical company and supply your products to Formosa, okay? Formosa is a big corporation, whereas your US company is a small one, and you are only looking for this Formosa only, right? Then you are in trouble. The geopolitical risk is non-trivial thing, okay? So in that case, your company also has to be having some kind of country risk related to Taiwan risk, right? Yeah, no consensus in this field yet about this country risk. How can we incorporate it? Okay. Why is that the case? Sometimes people say, well, country-specific risk. Well, that may be important depending on the portfolio manager's perspective. Okay, it gets back to the marginal investor idea. Okay, as long as your marginal investor is globally diversified portfolio manager, right? Then you don't need to worry about this specific country risk component, so that you don't have to model it, because you are well diversified all across different regions of the world, right? But if your marginal investors of your company is not globally diversified fund, but regionally, the country-specific fund, then you're still in trouble. So you have to price that or model that country-specific risk, okay? There may be some country risk component that you have to add to your risk model, kappa model, okay? How do you add those things, right? That's country equity risk premium approach, okay? Country equity risk premium approach. Some people say, well, country equity risk premium is not really discussed in Nobel Prize winning CAPM theory over there. So instead of sticking into this CAPM somehow, why don't we use some kind of scenario-based approach, okay? Use CAPM as its original model instead of sticking in country equity premium factor over there, but use some scenarios, two different scenarios. One is peaceful situation, the other is war situation kind of things, outbreak kind of situations, right? Good. So those things we're going to talk about it in the next slides. First, but when you see country equity risk premium related arguments, we are going to simplify those arguments, and then we are going to assume that CERP, country equity risk premium, equals the default spread of the country, okay, of the country that you're interested in, that your business is most exposed. In my example, Formosa case, Taiwan's default spread, okay. Now, in that case, what should be your equity risk, cost of equity or discount rate, RI? It should be risk-free rate plus CAPM like beta times RM minus RF plus the default spread of your country, Taiwan's default spread over here. Just add one item, okay? You notice that this is addition. So remember your true risk-free rate of Taiwan, for example, non-AAA country, right? This is non-AAA country. So we had to subtract their default spread from their government bond rate. Remember that? Country's treasury rate was there, okay, in our exercise. And then Taiwan's country treasury rate minus default spread, we did it to get to true risk-free rate, okay? Subtracted it out, but we are adding this thing back, the same thing back, okay? So that you recover country's treasury rate, okay? So country's treasury rate in Korean terminology, 국고채, should be here in any way, okay? But we notice there are two components. One is true risk-free rate, and the other is default spread, which is our country equity risk premium in our framework. Okay, so simply put, they are the same thing, country treasury rate, but we are analyzing it, okay, to have more precise understanding of it, what's going on. Plus beta times market risk premium. This is common thing, right? Just as what we did in CAPM, okay? No touch on it. So that's that. Now, I said there is no, how do you say, consensus way of doing reflecting country risk, right? In practice and academia as well, right? No consensus. In Damodaran's textbook, okay, he comes up with at least 3 to 5 different models of country equity risk premium, okay, but I'm not going to test you on these variations, okay. At your own reading pleasure, go ahead and enjoy it, but I'm not going to test you on this. If I should ask you any country equity premium related questions, that would be this format, okay, default spread format. Why? Because it goes together with what is commonly going through in practice in banking industry, in at least in Korea. Equity risk premium, modeling it into your CAPM model, it was one approach to reflect the country risk, right? Emerging market. Alternative way of doing it is don't touch the CAPM, okay? But let's use scenario, okay? Scenario approach. What is that? Well, project the cash flow under the assumption of normal business situation and estimate the value using your cost of equity or cost of capital, right? That's what we're going to say value normal, the VN over here. And then the other kind of scenario is project the cash flow under the assumption of distress business situation and estimate the value using R. That's something we're going to say VD, okay? V of D, assign probability P of having low or distressed outcomes due to the higher country risk, okay? So the value will be the weighted average, probability weighted average of your values, right? In different scenarios, right? So that's the idea. Now, give me some example over here. Yes, right? Now, let's see. Okay. Now, example. Remocon company. We expected this company or EE or Remocon, somehow let's call it EE. Okay, this guy will have cash flow of $100 million next year, and it is expected to grow at 2% forever. The risk-free rate is 2%, beta is 1.5, and market risk premium is 4%, right? What is the discount rate? Use CAPM model, 8%. And what is the value of the company? 100 divided by R minus G, that is 1666.67, okay? The company is actually in an emerging market where there is a 20% chance that the country would collapse, in which case the cash flow would shrink down to $50 million, right? Cash flow over there, okay? Instead of 100 million over there, okay? Value in case of collapse, okay? This is your V of D, right? That is 50 expected cash flow in the worst case, and R minus G still there, right? And so that's going to be 833.34, okay? And then your value will be simply the probability weighted average of your values in two different scenarios. That's 1500, okay? That's it, okay? That's it. Right, so that's the end of the slides, right? I hope you enjoyed this lecture, and then see you next time. Okay, bye-bye. Oh, any questions, by the way, ask me, right, via email, and then I'm going to post common questions and answers in the iCampus, right, using the following email address, right? Bye-bye.